Chamath Palihapitiya is a prominent Silicon Valley investor and founder of Social Capital, a venture capital firm focused on technology startups. His sharp eye for disruptive companies and skillful investing has produced phenomenal returns and enormous profits. Chamath developed a unique approach for identifying and investing in the next generation of leading companies. Let's break down the key components of the Chamath Palihapitiya investing strategy. Evaluate founders first. At the core of Chamath's investment playbook is putting enormous weight on the founders and leaders behind these startups. Chamath believes that while industries change and pivot, the single common thread in extremely successful companies is determined founders with relentless drive. He asks, does this person have the grit, vision, and potential to dominate a massive total addressable market over the next decade? If not, he won't even consider the business. Seek total addressable markets. This question around market potential leads to Chamath's next filter, total addressable market size. He exclusively invests in companies positioned to impact industries worth $100 billion or more in the future. The market must have towering upside potential, still untouched. He avoids traditional small markets, unlikely to produce stratospheric growth. Healthcare, financial services, transportation, and communication platforms draw his attention, given their immense untapped scale. Focus on platform business models. Chamath zeroes in on technology platform business models that lend themselves to explosive expansion. He cites examples like Amazon's fulfillment infrastructure, Facebook's social graph, and Square's payment rails that all solve key problems for entire ecosystems, enabling them to quickly amass users and partners. This built-in viral growth through a mutual flywheel effect creates direct network effects and barriers to entry. He believes platforms beating incumbents resistant to adopting innovation make the most lucrative investments. Research emerging user behavior. Palihapitiya also emphasizes that investors must deeply research emerging user behavior shifts before most recognize their impact. Finding these currents early and riding them before the masses do leads to the most asymmetric investments. For example, he studied Peloton consumers' willingness to pay enormous premiums for at-home fitness before most legacy exercise brands. That informed Social Capital's huge early Peloton stock acquisition, which soared over 7,000% in value. Optionality in business models. Furthermore, Chamath cites optionality within business models as an important factor he analyzes. He looks for young companies that demonstrate the potential to expand across industries and reshape traditional boundaries. The optionality lens helps gauge multi-stage growth prospects. For example, Amazon leveraged its core e-commerce platform and applied it to cloud computing and grocery deliveries' other verticals. Build relationships with founders. Unlike some investors, Chamath places major emphasis on building strong relationships with the founders he backs. He states that investing is ultimately a human business based on trust and communication. Chamath not only invests capital, but also provides founders with his knowledge, connections to key partners, and strategic advice around scaling their companies. He may join their board of directors. This close support network helps the leadership execute on the vision while amplifying possible returns. Leverage social platforms. Additionally, Palihapitiya leverages social platforms to identify promising startups before most venture capital firms discover them. He's active on Twitter, communicating directly with many founders, paying attention to the concepts gaining traction. If he sees talented teams working on big ideas, he'll engage them with feedback and learn more. Social feeds provide unique proprietary deal flow and access to rising stars. Maintain concentrated portfolios. As for portfolio construction, Chamath holds concentrated positions in his highest conviction companies rather than diversifying extensively. He believes owning 3 to 4 companies with world-changing potential over a 10-year period can make up for losing nominal sums on more speculative bets that don't pan out. However, he mitigates risk by staging capital injections after hitting key milestones before going all in on his best assets. Extended investment horizon. While most VC funds aim for quicker 5 to 7 year exits, Chamath stresses the importance of an extended 10 to 15 year investment horizon focused on long-term value creation. He attributes this horizon to his early days investing in Facebook, where it took nearly a decade for the full potential to materialize at scale, but the patience ultimately paid off spectacularly. He works closely with founders to realize the full maturity of their platform over the next decade. Preparedness for down periods. Despite the outsized returns Chamath often produces, his strategy also prepares for periodic down periods. He experienced the dot-com crash firsthand, which framed his conservative capital preservation perspective. Chamath positions his portfolio to weather potential multi-year downturns by limiting leverage and maintaining liquidity to support existing investments. His extended horizon and conviction in founders insulate him from short-term market swings. Chamath Palihapitiya has crafted a brilliant strategy for seeking explosive returns.